Welcome back everyone. As we can see, the S&P 500 being pretty mixed over the last few days, but the overall trend is still relentlessly upwards with new all-time highs almost every single week. We also in fact have gold hitting a record $4,000. We have Bitcoin toppling over the 125,000 mark, and at the same time we're seeing some massive market moves. OpenAI's new partnership with AMD were tens of billions, Nvidia in fact pouring 100 billion into OpenAI, and as well we have Oracle signing a recent 300 billion cloud deal. So is this all going to pay off, or are we in the middle of the bubble? And do remember, October historically is the most volatile month of the year, and with earnings season about to kick off, although we have had a quieter week to kickstart the period, it's time to look at 5 stocks that could fall before things get a little bit rocky. Thank you to today's sponsor, Market Dash. Honestly, one of the best platforms I've ever used, and what I love is that it brings so many tools together in one place. Take Amazon for example, a company I really like that I believe looks undervalued. Over the last 5 years, it is up only 40%, and with Market Dash, we can dig deeper. We can see what are the hedge funds and institutions doing, are the biggest holders buying more or in fact quietly selling, and we can also check the platform's intrinsic value model, which currently puts Amazon's price at $263. That's roughly, as noted here, 20% upside, and actually very close to my own recent analysis. There's also a built-in SWOT analysis that highlights not just the strengths and opportunities, but more importantly the weaknesses and threats. That's really useful when you're building your own investment thesis. And of course we can see what Wall Street thinks, with in fact 9 out of 10 analysts rating Amazon a buy and an average target price of $258. Plus Market Dash even lets you track inside activity so you know what the people running the company are doing with their own money. Honestly, it's an incredible all-in-one tool for investors, so thank you to Market Dash for sponsoring today's video, and click the link below where you can also get a 7-day free trial. Now we'll cover each 5 as well as give you our own perspective in terms of the valuation, kicking off with ASML. Remember, it wasn't that long ago they were in a continual drawdown week after week, month after month. A lot of this was down to the tariff fears, which ultimately led management to come out with a statement to say that they're unsure they're going to see any growth in the shorter term. On top of that, we have some breaking news today, although it hasn't massively affected the share price, but ultimately the US House panel has in particular slated their Chinese business. In fact, they go as far to say that it poses a threat to US national security. And we can take a look in terms of their second quarter, so most recent, 27% of sales were in fact to China. We also have the geopolitical tension with 35% of those sales being in Taiwan. Now the company's down around 2% today, just below the $1,000 mark, one that we were talking about as a very strong buy near its 52-week low. It's now on the other end near its 52-week high. Interesting, we get a double buy from Seeking Alpha as well as Wall Street. Looks to be good over the last year, up 22%. Year to date, massive comeback, up 42%. And as we've typically said, this one has massively outperformed the S&P, up more than 1,000%. Now we're just 1 week away from the release of their earnings, which will in fact be before the market opens on the 15th. And if we take a look at their expectations for this quarter, around 9% year-on-year growth. They have a strong track record over the last 4 quarters. They've outperformed in each one, but over the next 4, they're actually anticipating 2 of them to be a decrease, which in some regards you can put down to the cyclical nature of the semiconductor space. Earnings per share next full year just below $30 will lower their valuation to 34, which speaking of actually now comes to a forward P of 37.2. That is well above their historical 5-year of 33. Straight away we look at this as a potential overvaluation signal. This was a screaming buy when it was well below, and you can just see in not a long period it has in fact shot up. This was a very strong run up and now could be one for serious consideration, not as a buy but perhaps a hold or maybe a trim. And if we do take a look at the blue tunnel, we can in fact see now it is slightly above. Times to buy, where we would indicate severe undervaluation, is in fact where it does sit below even the bottom end. Now we notice for the first time in the last year it is looking potentially overvalued, which is quite interesting because this company for quite some time does trade at a premium to the market overall, yet we have noticed now for the first time since the middle of 2024 it is revisiting that premium status. Not typically an area where you do want to consider buying, but remember we don't solely look at this in pure isolation. And one step further, when we zoom out to the last 10 years, this one, as we can see, does at times trade undervalued, but it isn't a common reoccurrence. More often than not, as we've just said, trading at a premium. Now, it's not just the forward P that we want to look at, although we will point out that it trades at 42% of a premium to the sector overall, but on a price to earnings growth, PEG, it trades at 2.2, above the sector, so you're paying a 20% premium, but also above their 5-year average, and that is 24% above, so just something for consideration when evaluating the valuation overall. And if we look at their most recent quarter, well, top line was up 23% year on year. The vast bulk does come from EUV, where in fact they have an incredibly strong impenetrable, at least for the time being, moat. Nice to see improvements to their margins, efficiencies, 2 percentage points on the gross, 5 on the operating, and 4 on the bottom line. And also fascinating to note that these machines that they produce are very, very expensive, and they've been able to continue to increase the price. That is what we would in one part call a very strong moat. Over the last 12 years, they've increased prices 13% year on year. In fact, the average price we're talking for one EUV machine in today's climate sits at $189 million. And what they've been able to do in the most recent period is in fact do a lot of share buybacks, which we always say is one way they can return excess cash to investor pockets. Great to see they've done that over the last few quarters, although remember the price was a lot cheaper and now they have stopped that for the time being. And just more proof at the cyclicality of the nature of the business, their quarterly net bookings over the period, in fact we're talking the last 5 to 6 years, has increased 1.4%, but some quarters we can see massive increases followed by a massive drop. Lots to take into consideration. And finally, before we get to our own valuation, that cyclicality again coming through the growth numbers, 26% top line year on year, projected 9 or 10 over the next 12 months. Yes, it is better than the sector overall, but just look at their last 5 years. It just highlights this one, at least in the shorter period, hasn't had much consistency in terms of the growth. If we were to look at the earnings per share, they're projecting 17% growth year on year over the next 5, little bit above the sector, but actually lower than the historical 22%. Now, as we said, each one of these will give you our quick intrinsic value, where for ASML comes to $909, derived solely from the DCF model. Now, we have our growth rate at 12%, although first things first, on a reverse DCF model, this tells us baked in if you're buying at today's price is 13.3% growth to the future free cash flow already, so you can already gauge if you believe it's overvalued or undervalued. If you think growth should be a lot more, undervaluation, vice versa, growth less, then potentially overvalued. Now we have our growth rate, which as always we have a low, medium and high, 10, 12, 14, which is subjective, so you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others, but based on the growth rate and the discount rate, we get the present value of future free cash flow, terminal price, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, 909, indicating downside of 9%. Now you may believe this is too ambitious. Well, at 10%, $790, that's downside of 21. If you believe 14 to be most appropriate, well, just over $1,000, just a trivial 4% upside. Now using the middle rate of 12%, because we're not done there, we always want a margin of safety when we're buying, typically around 10%, where we buy, execute, if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. That would indicate a buy at $818, And actually, what we're seeing right now, no margin of safety. If you're buying today's date, you're paying a 10% premium. Now, if you wanted a margin of safety but more than 10%, well, at 20, a buy at 727. At 25, a buy at 681. Wall Street themselves, with their average price target, actually see downside into next year of 8%. That is $925. Now, let us know your thoughts, but we'll also flag here for those that believe we're being too conservative. At 14%, yes, there is upside, but the margin of safety is in fact very trivial at 4.2%. So let us know your views on ASML. Is this one actually where you believe is a strong buy? Is it a hold, or maybe not necessarily a sell, but perhaps a slight trim? Before we move on to the next stock, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning to your inbox, covering severely undervalued stocks, as well as what's going in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're looking at is in fact Netflix, which has come under the spotlight quite significantly in just the last few weeks. Even had Elon Musk telling his followers to cancel Netflix subscriptions, and this comes as an anti-woke cancel Netflix boycott. Now, I'm sure many of you do know what this is about, but if you want just a little bit more detail, you can take an in-depth look online. Now, the company is still looking very strong in terms of performance, up 70% in the last year. Year to date, also up 34%. Over the last 10, like ASML, up more than 1,000% in the last 10 years. Also, like ASML, again trading near their 52-week high, although we just get one buy rating today from Wall Street at 4.08 out of 5, forward PE at 44.2, where in fact we notice their 5-year average is lower at 41, so you are paying a 10% premium. And on a price to earnings growth, below 2 is typically where we would say something for a deeper dive. It sits pretty much around the 2 mark. But what's interesting to note, not that it's at a premium to the sector at 33%, but actually historically it's traded at a PG of 1.5, so you are paying a 32% premium. Now, they're reporting their earnings in a few weeks after the market close. The point here is to see is whether or not this boycott will be shown in the numbers, and if so, whether the market will react in a negative way, sending the share price down. And we love to see green right across the board, 100% performance against analyst targets, double-digit growth projected over the next 4, sending the forward P to below 37 if they hit those 2026 EPS projections. And just in their latest quarter, revenue was up around 16%, strong efficiencies to every single margin in the 6 to 7% region, and they're also improving on their margins. Remember, one thing we say for high-quality companies, the criteria is as follows: increase to their revenue, which most companies can do, but not something all companies can do, which Netflix clearly can, is improvement to their margins. Just over the last few years, we see operating going from 17 to 30, likewise gross margin showing strength from 38 to 48. And they also have a fairly low churn rate, which is actually interesting to note because this company, as I'm sure many people are aware, have time and time again been increasing the prices. Yes, we see the churn rate increase very slightly, but then it has in fact come back down and currently sits around 2.1%. We noticed beginning of the year it was sitting higher around 2.5 after the price increase, now coming down, pretty much highlighting Netflix's price inelasticity. If they increase prices, obviously not at a huge rate, but even very slightly, whilst we will get some people who do cancel their membership, it does tend to come back down to a fairly strong level. And also, the way things are going at the moment and only seem to be getting stronger and stronger is that streaming is where people spend most of their time in comparison to cable and broadcast. A couple of years ago, it was at 32%, now sitting at 46, of which when they stream, Netflix is the number 2 behind YouTube, going from 7.9% a couple of years ago to now at 8.3. And actually, whilst you may be looking at the company thinking the share price continues to increase, it's getting more and more expensive, you're actually noticing the opposite. The actual valuation is decreasing because they're able to become a lot more profitable. Earnings per share is just increasing at a very fast rate. And actually, in comparison to Google, what we're seeing is that at the moment, Netflix does have the larger revenue, but is growing at a slightly slower rate. Whether or not this trend continues, definitely something to watch out for. And their free cash flow looking very, very strong, at least over the last few years, where we are getting some consistency in terms of the growth. I'm now sitting at 8.5 on a trailing 12-month basis. And finally, growth at an A-, increased top line 15% last year, expected the same again this year, pretty consistent, well above the sector, in line or not too dissimilar from their 5-year average. EPS looking good, 23% over the next 5, above the sector, but actually, like ASML, growing slower than their historical rate. And our valuation today, $730, again derived from the DCF, highlights a growth rate used of 15%. Actually, we noticed free cash flow barely moved over the last year, and using a DCF reverse basis, 22% is baked in as of today. So maybe you look at these numbers and you think we're being way too conservative, but if not, at 10, 15 or 20, each one here indicates double-digit downside. Using the 15% rate, essentially saying right now, this company is trading at a 63% premium. Now look, Wall Street are actually very bullish. They see this at $1,400 into next year, 18% upside. And if we want to go one step further and say 20%, yes, you are paying a premium, clearly less at 15%. And for those that are interested, if we in fact go additionally above the high rate at 25%, as of today, you're looking at a 19% margin of safety where the intrinsic price isn't too dissimilar from Wall Street overall. Let us know though your views on Netflix. We then move on to Costco, which has been a downward trend for quite some time. Yes, it is up 5% over the last year. Year to date, it's now negative. Over the last 6 months flat. Over the last year, down 5%. And as we said, it is pretty much in the downward trend. It's also, as you can see, trading near enough at the 52-week low, huge pullback from 52-week high, and just one buy rating from Wall Street at 4.02. Now, they are due to release their earnings in about 4 weeks, where we notice growth estimated over the next 4 quarters, 75% track record, and even with an increase to the EPS, forward P still very high, estimated to drop to 41, where as of today it sits at 46, not only high in isolation, well above the 5-year at 39.4, and this is also something confirmed when we look at the blue tunnel. But what's fascinating to note, we could be days away from this entering just at the upper end, where the valuation could in fact turn into a reasonable signal. But actually, if we zoom out to the last 5 years, last time we got reasonable valuation was throughout 2023. From 2024 onwards, this has just been on a run where it has been offering you to buy their shares at a premium. And going one step further, over the last 10 years, this one is clearly one that very rarely, if at all, trades in a severely undervalued level. But remember, make sure you're subscribed, notification bell is on. When we see companies of Costco's quality severely undervalued, we will make you aware. Now, their most recent quarter saw top line up 8% year on year, very minimal efficiencies to their margin, which is to be expected. They are operating at some very low numbers. 13% gross margin, 3% bottom line, where they're trading at a valuation a forward P 187% richer than the sector, 7% above their 5-year average, and a price to earnings growth above 5, where in fact their 5-year was 3.45, meaning a 46% premium. And their growth comes in at an F. Just look at this in terms of the valuations on offer today. Year-on-year revenue 8%, expected the same over the next year. Yes, it is in fact above the sector, but slightly below their 5-year average, with earnings per share coming in at 9%, again above the sector, but below their 5-year average. Is this really truly something you'd expect from a company of this valuation? Now, there are some things they have done very, very well, is with the number of warehouses they've had, they've managed to increase the sales per one. If we go back the last 5 years, they've managed to increase it by 50%. But this is pretty strong, always great to see, because ultimately, even if they are increasing their warehouses for the number of sales to also increase, they're making every warehouse generate more and more sales. And as you would expect, they have managed to increase members across the board. But one thing that also led this company into a little bit of a sell-off after their earnings is that their comparable sales growth has started turning to a bit of a decline. 9% in February, now down to 6%. With tariffs and inflation, maybe we'll see this more in the numbers in the upcoming earnings. That could send the share price down even further. And finally, as we did just touch upon cardholders, it has over the last 5 years been increasing at a rate of 6.7%. Now our intrinsic value at $829 is derived using a growth rate of 15%, most recent year 18%. Baked in today, 16.4, which you may believe is very high. That could be a reasonable take. 10, 15, 20, in fact 10 and 15, both downside, 27% upside if you believe 20% to be most appropriate. Using the middle rate then, effectively telling us you are paying a 10% premium today. If you want a 10% MOS, a buy at 746, at 20, a buy at 663, and at 25, 622. Now look, Wall Street are bullish. They had a buy rating. See this at around $1,090 into next year, 19% upside. And if we were to use the higher rate for those interested at 20%, then what we're looking at today is a 22% MOS. Let us know your views though on Costco. Is it a buy, hold, or maybe a trim or sell? We then move on to Apple, which is up 16% in the last year. Year to date, up around 3%. Over the last 10, as I'm sure you're aware, outperforming the market, trading very, very near to its all-time high with just one weaker buy rating from Wall Street. Now they're due to report their earnings in a couple of weeks, 30th of October after market close, where the anticipation is growth for the EPS, but what we would say is very weak given how high this company is valued. Yes, 100% outperformance, but if they hit those targets for the next full year, forward P will come down to 32, which already seems fairly high. And as of today, sitting at 33.3, not only above the 5-year of 28, but in isolation again for the growth expectation of this company is a bit of a red flag indicator. And we also get that overvaluation signal here. It does sit above even the upper end, something it's done for quite a period in the last 12 months. And when we zoom out to the last 5 years, this is one of those companies that continue to trade at quite a large premium. Question is it in today's date worth the premium that is on offer? Now valuation, one of the issues we have with this company, as we mentioned, against the sector trading at a 37% premium, against their 5-year average a 22% premium, price to earnings growth trading at 3.44, 91% premium to the sector, 30% premium to their own historical. And this is our issue, the growth does not substantiate the valuation, 6% year on year, 5% expected moving forwards, below the sector, below their own 5-year average. And when we look at the earnings per share, 10% is expected, below the sector, quite rare to note, at 15.2, also below their historical 11.1%. Now their most recent earnings, we saw top line up 10%. In fact, nice to see iPhone, which was quite rare, up double digit 13. No efficiencies noted, not the worst, but ideally for a company like Apple, you would expect them to be able to improve on this. And one thing that will be very interesting to see in the upcoming quarter, can the iPhone revenue growth rate continue the double-digit climb we saw in just the latest quarter? Now our valuation, pretty much the same as it has been for a while at $200. Now we've used 8% growth rate, last year was at 9, average was at 7. Baked in is at 11.4. Now we believe this one to be overvalued quite clearly, as you can see, but even if you bump this up to 10%, we're still talking 232, indicating downside of 9%. If you believe 12%, well, upside is only very marginal at 4. So using the 8, which we actually believe to be the most reasonable today, we're talking a 28% premium as of today's price. Wall Street also see minimal upside, $260. We're talking only 2%. And if you believe we're being too harsh, well look, at 10%, you notice here still a premium of 11%. You really need to see this at a bare minimum of 12% moving forwards, which still only offers a 4% margin of safety. Let us know though your thoughts overall on Apple stock. We then move on to Palantir, which actually had a slight dip not that long ago as there were some claims of security issues within the Army platform, but the company still on a tremendous run, up 368% over the last year, 141% year to date, trading very near all-time highs at $190. Probably no surprises, but a triple hold across the board. Forward valuation, just a very low figure of 284. Not only that, but also a very low PG of 8, looking absolutely outstanding when the sector's 1.8, so you're only really paying a 345% premium, and when we compare it to any other metric, we're talking premiums in the 4-digit region. In fact, if you want to look on a forward basis on a price to cash flow, you're paying a 1,218% premium to the sector, coming in at 259. Now their earnings is about 3-4 weeks away, in fact 3rd of November after market close, and they are expecting strong double-digit growth over the next 4 quarters with a 100% track record, and the expectation of EPS at 85 cents will lower the forward P to 215. Now does the growth really warrant the valuation, where we get an A 39% last year, 36% expected moving forwards, above the sector as well as above, although only slightly, their 5-year average, earnings per share projected 35%. Yes, it is above the sector, but they're actually expected to grow EPS slower than their historical 44%, and their revenue came in 48% higher from the same quarter last year. No efficiency to their gross profit, but strong 11 percentage points year on year to operating and 13 on the bottom line, where they've managed to increase their billings at a growth rate of 57% year on year, and with all the contracts that we are hearing about on a near daily basis, it doesn't look like it will be slowing down, at least in the shorter term. Now our valuation gets to $95.28, where in fact we're using a growth rate of 35%. Baked in, we're talking around the 47% level, using 30% downside, 35 downside, 40% downside. Even if we were to put in 45, still downside, 162 the intrinsic price. So let's work backwards. Let's say you believe 45% to be the most appropriate growth rate. Well, then we're talking it's trading at a 12% premium. If you believe that is way too optimistic, well, at 40%, you're still talking a premium of 46%. If we move it down to 35 growth rate moving forwards, which is our middle rate, 91% premium. And finally, at the lower rate, where most people may believe to be the most reasonable option, again, another premium, 151. Now let's use the middle rate, as that is what we typically do on the channel at 35, and conclude 91% premium. Wall Street themselves see this, $155 into next year, 15% downside, but do let us know your overall views about these stocks today. Do you put them in the strong buy category, maybe the hold, maybe in fact a slight trim, or a complete sell or avoid? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.